the interest rate and taxes. Okay, so the next lecture, number 5, number 6, and number 7, are quite straightforward. Why? Because they are quite specific issues, not complex, so most of them what I will let to you in order yourself study the material, because they are not complex. So what we know until now, at this moment, is the most complex formulas we can handle in engineering economics calculation. So what are going to see is different aspects, lateral aspect, side aspect, not fundamental, but anyway, important. For example, interest rate and taxes. What happens if I go to a bank and they say, your saving account will be paid 5% annually, compounded rate. And you say, okay, 5% annually compounded. And the bankers says, okay, please notice that this interest rate will be paid off in your account every month. So every month you will be paid off for your interest. So those every month your saving account balance will increase because of that interest rate. So at the end, in a monthly payment of interest, you will earn more than if you are paid just one time per year. So in the case of loan or mortgage, usually we pay our mortgage every month. So the interest rate, the real interest rate, the effective interest rate we are paying is different than the annually we are offered. So sometimes when you go to ask for money, they call in your bank, they say the nominal rate is 5% and the equivalent interest rate is 5.03%, because the payments of your mortgage are made every month and not once a year. So that changed slightly our calculations, but the fundamentals are exactly the same. So not all the transactions involve the same periods of time. Therefore, we need an initial economic equivalence to compare cash flows. For example, a series of cash flow can be stated every month, so 12 periods per year, and the interest rate are paid every month based on a monthly interest rate instead of an annual one. So we need to find an equivalent interest rate of the different periods of transaction we can find in order to compare cash flows. So we often use equivalent annual rates. So when you go to a bank, they always say the nominal annual rate and the equivalent annual rate. In Spanish, the equivalent annual rate is the letters are identified with TAI. And the other problems we have to solve is taxes on earnings. So if you are offered a 3.5% of interest rate, this is the nominal, because after the end of the year, the bank will not give you a 3.5% more than the money you lend them. They will pay less. Why? Because taxes. Because governments call it taxes. In the case of Spain or in many European countries, this tax is 21%. So you will receive not the gross interest rate, you will receive a net interest rate, which is the gross interest rate times 1 less the tax rate. So, because the interest, how does the bank quote the interest rate? Because the interest payment may not be annually, but for example monthly or quarterly, the banks use two different quotation. The first one is the nominal interest rate or annual percentage rates in the case of for example in Britain, they call the annual percentage rates, or and also the banks are obliged to give us the effective interest annual rate, the EIR, or annual percentage yield. So the effective interest annual rates takes into account this number of periods of payments, monthly or quarterly or annually. So if the interest payment is annually, then the effective annual rate is equal to the annual percentage rates. But if the interest payment is not annually, the nominal monthly rate we can calculate as the nominal annual rate divided by 12. But in that case, the effective annual interest rate is different than the annual percentage rates. So what interest rate we use in time value of money calculation? We always use nominal rates, annual percentage rates or monthly percentage rates, but always nominal rates. For example, if we decide to make our calculation in months, we will use the term will be the number of months, not the number of years, will be the number of months. So for example, in 5 years, if our calculation are going to be done with the monthly nominal interest rate, we will be using the number of months, will be n equal 12 months times 5 years, so 60 times of periods of time. What interest rate we are going to use? The monthly nominal interest rate, which is the annual percentage rates, the nominal one, divided by 12. So usually banks, as I have said, the interest rate are quoted, are stated in terms of nominal and annual values. Besides, the period interest payment could be monthly or quarterly. For example, a saving account paying you a 3% interest compounded monthly, the nominal interest rate or annual percentage rate is 3%. And then each month the bank will pay, and this is compounded monthly. This is the key message. The annual nominal interest rate is 3%, but each month the bank will pay you a 0.25%, which is the nominal annual interest rate of 3 divided by 12. And then this 0.25% is compounded monthly compounded interest. So it means a 0.25% of the cash in the account at this moment. So at the end of the year, you will have accumulated interest of month over month, over previous month's interest. And then the annual percentage rate of 3 is commonly used, does not explain precisely the amount of interest you will accumulate in a year. Which rate describe precisely this amount, the effective annual rate? So what is the effective annual rate, or EAR? Is the one rate that truly represents the interest earned applied in a year. It reflects the amount you will receive in a year, independently how often you are paid. So the only correct method to compare interest rate is through the EAR. So we need to transform the nominal rates, APR, to effective annual rate, considering the number of periods per year which involve the stated nominal rate. Let's see an example. You have a credit card, and this credit card pays a 18% compounded monthly, applicable, to the time period you keep in negative your credit. So what does it mean? Your bank gives you a credit card, and then you have spent this month, you don't have enough money this month for paying 1,000 euros, which is in your credit card balance. But you expect to pay off this amount the next month. How much will you be charged the next month? 1,000 euros? No, of course, the bank is their business, is to charge the interest rate. How do we calculate at the end of the next month how much I will be paying? Okay, the calculation is like that. What is the monthly interest rate? Is the annual rate divided by 12. So the the interest rate monthly, is the nominal one stated by the bank. They say 18%, which is annual, but they say compounded monthly. So this is the interest period, the interest rate period we are going to use. So 18 divided by 12, the number of months. This is a monthly rate of 1.5%. So we call this M compounding periods. Then this is the IM, the compounding periods, in that case month, is E annual, the I annual divided by the number of compounding periods, in that case M equal to 12. So the future value in 1 month, we know how much we are going to be charged in our credit card. Is the present value times bracket 1 plus the monthly, the effective annual rate, the nominal rate, which is IM, to the nth power, in this case n equal to 1. So at the end of the next month you will be charged 1,015 euros. But for example, if you want to pay this amount, 1,000 euros, in a year later, then M equal to 12, and then now is the number of periods is 12. So you will be charged this interest rate every month. So that final amount will be very high at 80%. So every month I will be charged the same amount, the 1.5, because this calculation is the same always. The number of periods is 12. So the future value is the present value, the interest rate of every month, and the number of months. So the result is 1,195 euros. So what is the effective annual rate that you have paid at the end of 1 year? So we can calculate the effective annual rate in this way. The effective annual rate is equal to the final value, the future value you have paid in 1 year from now, 1,195, divided by the present value minus 1. So this interest rate is 19.56%. Higher, this equivalent annual rate is higher than the annual percentage rates of 18. Why? This is due to the monthly compounding effect. So you see here this diagram, explain what happened. When you pay every month, the interest period is every month, the annual percentage rate is 18, compounded monthly, it means that you will be charged a nominal of 1.5% every month, and you have 12 interest periods per year. So if you calculate the final annual rate you are paying, the real, which is the effective annual rate, it's 19.56%. This is the interest period, this is annual, and this is compounded annually. So those interest rates are equivalent. The annual percentage rate compounded monthly of 18 is equal an effective annual rate of 19.56%. So financial institutions usually quote both rates to facilitate customers, the nominal and the effective one. So the formula for the effective annual rate is this one. Is 1 plus the annual rate, R, divided by the number of compound periods to the number of compound periods less 1. Where does this formula come from? It derives from equaling the future value of both interest for a year of a present value amount. So, look, the future value of any loan will be the same. So, what we use is this equation. We make equal the present value, the future value calculated with 1 year period at the effective annual rate interest rate equal to the compounded monthly or every M period, the present value of 1 plus the interest rate compounded, which is the nominal divided by the number of periods. So if you clear up EIR, this is the formula, so it's not strange for us. Examples. You are offered a saving account at 3.75% nominal rate with monthly payment. What is the effective annual rate? So it's easy. We apply the formula, and at the end, as you see, the effective annual rate is always higher than the nominal one because of the compounding effects. You will be paying, or you will be paid, interest over interest of the previous month. Another question, for example, if the interest payment are quarterly, so not monthly but quarterly. You know, a year is divided in 4 quarters, so it's 3 months each quarter. And then, what is the number of periods? As the year has 4 quarters, then the effective annual rate, the M is equal to 4. So you can calculate that the effective annual rate, in that case, the 3.75 nominal rate, in case of effective in quarterly payment, is 3.8%. And if you are paid daily, M equal to 365 time periods, the interest rate is 3.8821. So that's the idea, that as the number of compounding periods increase, as the frequency of compounding period increase, the effective annual rate increase. So in Excel, we have formulas to calculate that, effect and nominal. You see here, in Spanish, interés efectivo, and you see the nominal, tasa nominal in Spanish. No? You see here that the nominal, okay, so you have here, and some products are use the continuous compounding. You always, from, in this case, M is equal to infinite. And then, okay, so you have here the formula, don't worry about that, it's here. And for example, here you have a problem with different time periods, daily, continuously, annually, quarterly, and calculate the equivalent annual rate. So, for example, you have today 10,000 euros and you want to know how much will you have in a year if interest rate are compounding in different scenarios. How do we calculate? Okay, the formula is the future value, the present value equal to 1 plus the interest rate, the annual interest rate, the nominal one, divided by the number of periods to the M power, and the effective annual rate we know, and then we know several data. No? So for the case, for example, of monthly payment, the future value is the present value, 10,000 euros, times 1 plus, and then what is the monthly rate? You have to be consequent with the time period you are using. So if we are using compounded monthly, we have to use the nominal annual one and divided by the number of periods in 1 year, which is 12 for monthly, and then to the 12 power, no? And then the payment, future payment is, the future value is 10,407. What is the effective annual rate? You can calculate. So as you see, this is most important message, is that the future value you have to use nominal rates, the correct nominal rates, and you must be coherent in the period of compounding is this nominal rate or this investment, and using the number of periods, the same number of periods. Just the only you have to take into account. So you have here several with Excel done, okay, and you have here different problems, and I would like just to see this one and finish ending with that. Just 1 minute, please. The slide number 17. Slide number 17 is, you want to buy your first car. You see here a beautiful car, and you want to buy, after having saved it, you have saved 10,000 euros in your first 3 years working, and using this amount, 10,000, as a down payment for buying the house. Your ideal car is this one, a Volkswagen Golf, like full equip, which costs 27,420 euros. So you request a loan for the money you haven't to your bank, and they offer a 7% compounded monthly in 4 years. So how much will you be paying every month? How much will you pay for the entire car after 4 years? What is the effective annual rate? So the problem can be solved with that simple Excel file. The first question, how much I will be paying every month? I know that the payment is monthly, so I have to convert the annual nominal rate. The bank says, the car house say this is 7%. So as the payment is monthly, I have to divide 7 divided by 12. This is this number. The number of years is 4 years. So as the payment is monthly, the number of periods for calculation will be months. So the number of period, the number of periods, payment periods are times plus 4 times plus 12, which is 48 months. The cost of the car is this one, 27,000. I make a down payment, so 10,000. Then the loan I'm going to ask to the bank, to the car finance dealer, is the difference, is the subtraction between the cost and the down payment. So at the end, I'm asking for a 17,420 euros. What is the monthly payment? We know. Do you know which problem is this one? Remember, equal uniform payments. We know the present value. We know the interest rate. We know the number of periods, and we want to know the periodic payment. So do you remember, I think this is the capital fund. So we see here the formula. We see here the formula that what is the monthly payment is the PMT, the payment formula, equal to the what is the interest rate. Please remember, we are calculating a monthly payment, so the interest rate must be a monthly interest rate, nominal one. This cell. The number of periods must be the number of months in the full length of the full period of the loan, 48. What is the present value, the loan amount, 17,000. What is the future value? I will not borrow any money from the bank at the end. So that formula gives us the payment, which is this one, 417 euros. So please remember, when you are reading advertisement, that those calculations are based on that. How much I will be paying? Of course, that's the second question, is 48, the number of months, as the periodic amount is uniform, multiplying both amounts. So remember, the loan is 17,000 euros. At the end, you will be paying 20,000 euros. So that's the business of the banks. And this is what make that car affordable for you. So what is the effective annual rate? What we'll be using is the effective annual rate formula. You can use the Excel one, which is effective rate or interés efectivo in Spanish of P2, which is the monthly payment, and the number of periods, 12. So you have here the example, and you see, okay. So thank you very much. We have ended this period of lectures. We will have this the next month, March, for doing exercise. I will be publishing, I will be uploading in the next days. So I hope next week on Monday or Tuesday you will have the problems. So I think the number of problems, the number of exercise will be in direct relation with the number of credits of the course. So I think they will suppose, in terms of your load, a number of 10 hours of personal work. So you will have to send me by the end of March or by the end of the first week of April, and then in the first week after Easter holidays, the first week of April, we will have another, I think, 3 or 4 sessions, and then thank you very much. What happened with the lecture number 6 and the lecture number 7? Excuse me. The lecture number 6, I think, is not important. The effect of inflation. So please read, and you will understand by yourself. It's quite easy. It's just the situation of including or not including the inflation in our rates. So remember, please, we are always working with nominal money. So the amount of today, and then what you have to do is to include in your calculation. If you are working, for example, with price, suppose that the price you are working will increase in the next year. So use an inflation rate in your internal calculation, and then all the economic engineering economic calculation, consider the nominal price, the nominal revenues you are using, or the nominal cash flows, but keep in your mind that those cash flows must be generated taking into account the inflation. So that is not difficult. And the last lecture is the number 7, the net debt management. That is quite also self-contained material, so I think you can understand by yourself. If you have any question, you don't understand something, I will be fully available for all of you to answer your questions through email or through the chat or through the the news or the forum we have open in the course. So thank you very much for your attention. Sorry for the delay of 7 minutes, but I needed to explain what the next step. So thank you very much. Bye bye. See you.